Hi, hi everybody. I'd like to discuss problem 23-33, which is a nice kind of segment reporting question where you get an opportunity to reallocate, essentially kind of move around between the product level segments and territorial or geographical segments, right? So it's nothing but kind of a fairly simple Excel exercise, but that's actually kind of important, because segment reporting is very important for understanding companies' performance, especially for a multinational company that could operate multiple geographical markets, multiple product markets, how they relate. And so this is nicely illustrated here. So what you could see here first is that you are given, there's three products: motors, generators, power distribution, and there's a kind of a 2 by 2, right? So those three products for a company are produced, if you will, in three different segments: Europe, Asia, and Americas, or sold really. So company operates in three segments, and you want to be able to essentially prepare an income statement first by product line, then by geography based on the allocation data they're given. And that's what we're gonna do. So it's you're given data on sort of allocation first, on variable cost second, and then you're given data on the unit sales and prices, right? So that's what we're going to do in this problem, this nice problem. So I also prepared kind of my own Excel spreadsheet. I didn't like the way the textbook does it. It's not very, or the authors, like the suggested solution does it. It's a little bit unclear. Just you have to do. So I actually went there and recast it all for you in a nice Excel spreadsheet with formulas. So first you're given this data. So first we're doing the product line income statement, which is kind of the easiest thing to do here. You're given information on, so there's motors, generators, power distribution. In the very last table there, the problem, you're given information on the unit sales, unit prices. So that immediately gives you information, calculation in units, unit revenues, which is simply column B times column C, and you can kind of drag it down and calculate total revenue. Then you're also given, in the second exhibit, sort of in the middle, you're given information on variable costs, right? So the next step is to calculate variable costs. So again, the same quantities for each product times the variable cost. It gives you total variable cost. Voila, you have a now contribution margin for every type of product. It's just simply corresponding, let's say for motors, it's motor revenue minus motor variable cost, and so on, right? So that gives you contribution margin. So the next, you're also given information on depreciation and supervision by product. So you can simply, that is given to you in second exhibit by product line. You simply add it here. And once you have that, you can kind of calculate something called the product margin, which is essentially profitability or margin of the product with after direct costs, right? There's a direct cost, all of this variable costs and fixed direct costs right here. So that's what you have here. So that's just contribution margin minus the depreciation and supervision. That gives you that. And then you have common expenses, which are not allocated to individual products. So you can subtract them simply in total, and that will give you total net income. So that's just all it is. Now, then the next step is to recast it by product, by territory, by geographical segment. You're given information in the very first exhibit on the allocation of each product to each territory. So, for example, motors are 40% produced in Europe, 35% produced in Asia, 25% produced in Americas, right? And for each one. So then simply you can take the information of the product revenue, you can multiply it by allocation percentages. So your total revenues for motors was 162,500, and you simply just will allocate using these percentages, allocate to the three geographical markets. Notice that, of course, basic arithmetic, the whole revenue stays the same. You simply just split it among the different buckets. Once you've done that for the other two products, you got yourself a revenue allocation by a territory, because you can simply add up allocation of each product. This will give you for each territory what the revenue was. You're going to repeat the exact same thing using the exact same percentages for the variable costs, and it will give you variable costs for each territory when you add up the allocation for each product. Once you then once you have revenues minus the variable costs will give you the contribution margin. You are given also in the first exhibit information on fixed administrative and selling costs by territory. You simply just need to add them in. Once you subtract it from this cost from, as you can see, I'm doing that, simply subtracting this cost from the contribution margin, it will give you what's called territory margin. Then some of the costs are still remaining to be allocated. Remember to get to net income. So, for example, depreciation, we don't allocate it by territory. We're not told like how to allocate it. We're just going to treat it with a common cost. Other fixed manufacturing overhead, they're also given that number, I guess, not allocated by territory. It meant maybe like the CEO's had, like the corporate headquarters or something like that. It's just you don't want to put it down on a particular territory. It's not fair because it's a common corporate cost. And then some other unallocated overhead. Now that unallocated overhead, of course, you have this total overhead here of these two numbers. And we're told up on top of the problem that it's $200,000 additional overhead to get yourself to 1045. And so once you did that, you still have total net income of 2,355,000 on the geographical segment basis, just like you would under the product basis. Part 3 wants you to recast the data just to the income statement or kind of products territory income statement for just the Americas. And that's just simply like you have all this data already here. So you have the Americas revenue here, you have Americas variable cost here, you have the Americans contribution margin here, you have the Americans fixed and selling costs, and that's just it, right? So you simply it's just a matter of copy and pasting, and that's the part C here. And that's just kind of a nice, neat problem, but it's actually kind of a practical problem, you know, and companies oftentimes you have to do things like that. So thanks for listening, and you have a wonderful day.